very pleased to welcome Michelle Nunes-Vaz to talk to us about all these changes to trusts that we hope you'll get a lot out of. Thank you, Michelle.
Thanks, Rhonda. Welcome, everybody. When I started in business about 20 years ago, I had the aim of specialising in trusts. As a result of this name, I've attracted clients to the practice that have trusts, and so I really do try to keep abreast of the changes that affects trusts in the accounting space. The changes that have come in very recently involve both tax and trust, so very relevant for me to do a little bit of research, a few seminars, some books and some research on the IRD to try and come up with an information that would be presentable to you so that you know a little bit more than what you've been told by the Inland Revenue so far. What we're going to go through today is a helpful change mindset, because there is change involved in this process, why trusts are used, and I've got a personal story to add to that one, some background to the changes, information that the Inland Revenue already collects and knows, when the new rules apply and who they apply to, the exempt trusts from these new rules, and I'm expecting that there will be quite a few trusts in this practice that will become exempt. Reportable information, these are the specific changes, the Inland Revenue's restrictive powers that they've always had, and the expected implications for you as a client. So, reviewing the changes of trust reporting and the change that we as trustees will have to face brings me back to this emotional cycle of change mindset. And I wonder where you feel on this space. Feel free to respond with a phase 1 to phase 5 in the chat space right now, because interaction is always very interesting to hear. We are all going to get to phase 5. However, there will be some pain in working with changes. And unfortunately, as this law is passed, most of us don't have the opportunity of quitting. But some may reconsider whether they want their trust in the future, and there'll be more on this in later in the presentation. So I've made every effort to make sure that the information I'm sharing is factual, correct, and helpful. It's no substitute for tailored advice, though. So it's an educational general webinar rather than specifically to your situation. So as you know, trusts have been used for many years in generational protection. So my personal story happened to me this last week. So on Friday, a girlfriend of mine, we'll call her Julie, contacted me and said that her mother had died. And so I sent a quick text to say, let me know if you need anything right now, otherwise I'll, catch up with you on Monday. But in my heart, I was really joyful that years ago, approximately 4 or 5 years ago, we had discussed her mother, and we had set up a structure and a plan for her when she passed. And so this time of grieving that my girlfriend Julie is going to be going through will be made easier because of the structures that we had set up. She, the mother, has been living with my girlfriend for the last 15 years. She has one other child. There are 2 children, so there's 4 grandchildren, and my friend Julie has married somebody who has children, so there's stepchildren. And so we set up a structure according to what the mother wanted, which was that the estate money from her inheritance would go down and be going mainly to the children of the relationship, and the children and her grandchildren, rather than the step-grandchildren, which will get a bequest, but not the full inheritance. It's just we used a trust that was set up then, and that's the way it's going to be happening. So there's lots of reasons to set up trust, but intergenerational protection of wealth is one of the strongest ones. My question to you is, why did you set up your trust? If you can remember, write the information in the chat section so people can see your reasons. Most common reasons are here. Intergenerational asset protection I've just mentioned, protecting personal assets from creditors, which is quite common when you have set up a business and you are wanting to keep personal assets separate from your business. Setting aside money for special reasons such as education or health for specific wealth family members. If you've been through a divorce and you're separating, you're wanting to protect your the joint family wealth into a separate trust for the children, and other ways as well. There's many reasons, and a lot of them are still valid today. In the last 5 years in particular, trusts have been increasingly examined and broken up even through litigation at courts. And the Trust Act in 2019 came in to try and improve the transparency of trusts and also the record keeping of trusts, and the financial statement requirements started really back there. Trustees' responsibilities increased from 1st of April 2020 through the Trust Act 2019. In addition to judicial scrutiny, trusts have required the extra due diligence from anti-money laundering, which passed into legislation for accountants July 2018. So this change is just a further step. So it's been happening for a few years, and now we've got another one change. The IRD have got a renewed interest in the transfers of wealth between parties that may have been hidden historically in the trust documents. Quite often we don't even know about it as the trustee accountant, or the trustee's accountant. The Taxation Amendment Act of 2020 was introduced into law late March 2022. So this is really recent stuff. So what does the IRD want to know more about in your trust? Well, the policy behind the new IR recommendations is that it supports the Commissioner's ability to assess compliance with the 39% personal tax rate that it's recently introduced, and to make sure that that tax policy is working effectively to tax higher income earners of personal services income at 39%. If it's not working, then they'll see an increasing use of the trust to divert income and pay tax at 33 cents. So they are monitoring the use of trusts, and particularly the new trusts that are being formed. Trusts, the IRD also want, through the new information that they are gathering, to find out more about the use of structures and entities and how trustees distribute income using them. So it's clear from the Ministry of Revenue, Grant Robinson, that if the ISE systematic use of trusts to tax income at lower purposes, it's going to make legislative change to line up the tax rates. It's not that that's wrong at the moment, but it has to be done a certain way, and it's particularly worrying if it is income used, personal services income that's being distributed rather than investment income. So in October last year, the IR released a draft of all the changes in the reporting standards, and the accounting bodies CANS, ATTAINS and CPA all said back to the IR that these changes were massive and that they would be increased significantly the compliance costs for trustees of trusts. But there were a few changes, but not many, and the law was passed, as I said, just a couple of months ago. So historically, trust deeds have been sent to the Inland Revenue when you apply for an IRD number, and from that trust deed, the IR was able to record who the settlor was, who the initial trustees were, and who the power of appointment in the trust was. And we'll go through those terms in a few minutes. The distributions of income was captured by an IR in the IR6s when we distributed income. However, capital distributions weren't captured, and these are one of the things that are going to be captured now. So if a trust previously derived business or rental income, we used to prepare an IR10. And since 2019, financial statements also had to be prepared but not supplied. Some income and expenses were itemised on the IR10 and the IR6, and the IR already within existing law had wide-ranging powers to request documents and collect that information under the Tax Administration Act. But they brought in more law to make it extra clear for us as accountants. So when do the new rules apply? They apply from the 2022 year, so from now. For March balance dates, it goes back to 1st of April 2021. So the legislation came in March 22, retrospective starts 1st of April 2021. The applicable trusts, and I'm going to repeat this, are any trusts with taxable income and or a requirement to file an income tax return. So the applicable trusts for this new legislation are only trusts with a taxable income currently and a requirement to file an income tax return. So any trusts that do not receive taxable income should not be affected by these new rules. So that should make a lot of you feel relieved. A family trust that holds a family home and has no other income, these new rules won't apply, and you can leave this webinar if that's all you needed to know. So the exempt trusts are non-active trusts that don't derive an income. These trusts, though, have to complete a non-active declaration requirement to remove the requirement to file a return. Otherwise, the new declaration rules in section 59 will apply. You can ignore bank fees less than 200 or interest less than 200. You can ignore the costs of running the home, the rates, the insurance, things like that. If a non-active trust becomes active and has trading income, though, it's important to let the Inland Revenue know and begin filing tax returns again. And these other trusts, estates, unit trusts, are not required because they're not seen as active trusts. Just going through this terms in case I don't lose anybody. This is a normal trust. So we have the settlor, the people that put the property or the assets into a trust. We have the trustees, which is either individuals or a company, and then we have the benefit, who the trust of money eventually will be going to, and in the meantime it might be other beneficiaries. So mum and dad, maybe a company here, and then mum and dad might be a beneficiary, and then the children are beneficiaries, or a charity or something else. Appointers, power of appointment is given to somebody to replace the settlor if something happens to them. And then usually there's a sale of assets to the trust, loan taken back, and then forgiveness of trust assets happens by deed. So that's a normal trust. Trustees, settlor, beneficiaries. I'm just going to be using those terms so fast. I want to make sure they're really clear in your head when I'm starting to use them in the next few examples. So this is an example of a non-active trust. And I'm going to read the example. Jane Smith owns a residential property that is occupied by Jane Smith. The holding costs are paid by Jane. She doesn't pay rent to the trust. Pretty normal. Jane Smith Trust also has an interest bank account and is advised to deduct tax on interest at 33%. She doesn't earn more than $200, so she's under the threshold for the new law. It has an IRD number, so traditionally while she's filed tax returns, she quickly throws an IR 633 saying the trust is non-active, and that's all she has to do. It's really simple. Unfortunately, we don't have many clients in that situation. So make sure if you do, though, that you do file the IR 633 as soon as possible. Now let's look at another example. Bill Burns, he also has the same facts. He owns a house and doesn't pay tax, doesn't pay rent. He has an interest-bearing account and is advised to deduct tax on interest at 33, but he does earn more than 200. He earns 700. This trust has an IRD number, historically has included interest in the tax return. This trust can't file an IR 633 they're going to be required to file according to these new disclosure requirements. And that's going to be for the 22 year. And when they close that term deposit, take the money out, put it into a personal account for the, say, Bill Burns. They're going to have to file it for the 2023 year before they can file a non-active return. So some of my work this year will be not removing trusts, because there might be family home and non-producing assets in the trust, but actually removing income from the trusts. For some returns, that's correct. So this new reportable information, what's required? There's financial information, there's new information about settlers and settlements, beneficiaries and distributions, and persons with power of appointment. Very quickly, I'm just going to summarize that. For the financial information, there's another distinction, and that is between those trusts that have more than $5 million worth of assets and more than 100,000 terms of income or expenses. Those trusts have to do accrual accounting, and the other trusts have to do all the same reporting but can use cash accounting. For those accountants on the call, you'll understand that, and if you're not an accountant, we could discuss that if you feel that you want to understand more at the end. So the financial information that the IR are requiring includes all of this column. One of the things that is different, because previously, because of the Trust Act 2019, financial statements were required to be prepared. However, we weren't having to specify what the financial arrangements were, and the equity broken down into trust capital drawings, balances, and movements in beneficiary accounts. That's a lot more detail than what we had to have before. Now, there is an Order in Council document on this, which isn't very long. It's only 7 pages, so it's a lot easier to read, perhaps. And if you type LI 2022.56, I think it's on the next slide, you'll be able to see it. In the Inland Revenue website, there's a handy flowchart that you can begin to complete for every trust you touch. I believe most of the trusts that we work with will be affected by these additional reporting requirements. So this is a little bit of a cartoon. And that non-active filing declaration form that I mentioned earlier, really that is that last one. Please remove your name from my mailing list to the Inland Revenue. You can actually legally do that. So the settlers and settlements, the details of any settlements during the year include cash, financial arrangements, land, buildings, share ownerships, interests, services, settlements that have been valued at zero, and other things. In the 2022 year, we also have to talk about names and details of prior year settlements. So that's getting a little bit more detail than what they've had previously. Now here at Tax and Trust, we've got 2 options. We can either use a trust register through cloud software. We use a firm called ConnectWorks, and we prefer using that for our active trusts. We also have a template form we can utilize, which is particularly inactive for particularly good for inactive trusts. Here's 1 page of it. There's 10 pages in the whole register. These trust registers that we use will help us complete the names and details of prior year settlements. And remember, it only has to be disclosed in active trusts. So depending on how long the trust is, that requirement may take quite a few hours going through what's happened in the past. One of the things that have changed also is the definition of a settlor. So in the past, a settlor was somebody that settled property, you know, on the trust at the beginning and possibly through the life of the trust. But now beneficiaries can quite easily become settlors, because anybody that gives more than $25,000 worth of value to a trust in any year is known now as a settlor. Settlements can be made of things that aren't distributed, like uncashed, such as a beneficiary living in a house rent-free, and that has to be disclosed in the Trust Act. There's quite a lot of detail on the new trust IR6S forms, 6S form that we need to complete, and I've actually got an example of that coming up in a few minutes. So Socks and Boots Trust was settled by Lane and Kane Socks. In January 2022, Jane Socks transfers a car to the trust for use in the business. And so in the 2022 tax year on the IR6, we have to disclose the value of that car if it's over 25,000, and Jane becomes a settler to the current trust. We also have to disclose what the original settlers had put in, which was Jane and Kane. So there's a bit of work to be doing in that field. So this is an example of the IR6S form. It's a new schedule, a new form that is part of the IR6, and it has to be included. In software, it's included in our XPM trust software. It's just the same form, just put into a software. It can be found at the bottom of the IR6 forms under, add forms, and it's compulsory. For completeness, a distribution is defined as a transfer of value from the trust to a person who is a beneficiary of the trust. So all of these details have to be included now in the trust beneficiary return. And specifically, as I mentioned before, capital distributions and the amounts withdrawn and enjoyed. So these are the transfers of values that weren't taxable, but from one capital account for the trust, beneficiary's capital account has to be disclosed. And interestingly, the jurisdiction of the tax residency also has to be disclosed. So that's going to create some tax effects of transfers of gifts in New Zealand and other countries that our clients may be citizens of. And we don't often know about these other consequences when we put money into trusts, but fortunately, we're going to need to know what the jurisdiction of the tax is, and that may raise us as accountants, we may be able to ask some extra questions about that, because this information will be shared across cross-country borders. Keep in mind, with all the detail that's required on these IR6B, this is the beneficiary return, which is a new return. The IRD are trying to understand where distributions are being made, and particularly where they're using a lower trustee tax rate than 39%, and if there was any personal services that are being attributed to beneficiaries. That's what they're really looking for. So what's the implication for all these new roles? Well, we expect that there's going to be more time and cost involved in every trustee gathering information that the accountant's going to need before we can prepare the IR6S and IR6B returns. Accounting fees are going to go up. There is a lot more work disclosing that information and working out which box they apply to, and we won't always have that information on file. There is going to be some overseas sharing of this information, absolutely. That's why the tax jurisdiction information request is there. You can also expect it across government departments. So social welfare, for instance, may find out that a beneficiary is living in a house rent-free, and that may have consequences for their benefit if they didn't know it before. So the IR will be able to request any of this information they get in the 22 year back to 2015. So for the past 7 years, we don't expect they will. They've got 500,000 trustees with new information coming in, but there may be one or two trusts, and particularly high wealth individuals, that they're looking for and that they can go back to. So we're going to keep that information for years. I'm just noticing the time, and I'll hopefully be finishing in the next 6 minutes. I'll be aiming to, that's for sure. So the new trust disclosure rules, we're going to have a four-prong approach for it. The first one, we're going to review first the trusts that we believe need to comply with these rules. Secondly, we're going to collect the data that we need and make sure the record keeping of the trust is adequate. in line with the Trust Act 2019. Third thing we're going to do is actually prepare the tax return, review it with the client, and then submit it to the IR. We're actually decided to submit our returns probably late July and August, giving us a few months to really go through this with quite a few trusts and make sure that we're getting the information correct. There are still questions and answers being asked by the Inland Revenue every day by accountants as we grapple with these changes. So I'm just going to hold off filing returns for a little bit, make sure that my first returns are as correct as my one, the 30th return that I've done. So reviewing, we're going to look at the trust client base, check which clients should become non-active as soon as possible, and which clients have to report on a cash basis, and which clients have to report on an accrual basis. If you're an existing client, that is what we'll be doing first off. We are starting with that already. We're doing that work already. We've shared this information in newsletters already. We are sharing on this webinar as a resource for our clients who are trustees. And then we will plan to have an individual email or letter or phone call or meeting with our clients to advise, collect and prepare their tax return. We are going to suggest audit insurance for any trusts that we don't believe have got the record keeping requirements completely satisfied. The next part of our number 2 is data collecting. So once we've captured the beneficiary information that we need, and a lot of that we don't have on file at the moment because we haven't needed to previously, we'll update our work papers and we'll go through carefully the settlements that are happening in the past, the major events, and capture the historical settlers where we can. Then we've got to put all that information into the database, prepare the financial statements utilising, as we normally would, the taxable financial statements. We'll prepare them as we normally do, but then we add that information with the other information that we've already gathered and prepare the tax returns. So this is a really good slide to do a screenshot or a photo of. This is the sort of information that we're going to be requiring for all tax returns that are active from now on. This is a lot more detail than we've needed previously. And you can see the proof of ID and the ID for beneficiaries. That was definitely not something that we've collected in the past because we have only done AML on clients that were new to the firm, but we're going to be collecting all of that because that will help us with when we answer these tax residency questions, etc. So then we prepare the return. We will make sure that the financial statements that we prepare show clearly on the notes to the accounts the valuation methods that have been used in the preparation of the accounts, such as like market value or historical cost. We're going to have to really be careful on the beneficiary movements because they now have to be notified, and I'll be having some templates for that, because every beneficiary will have its own beneficiary return in the Trust Act. We're going to have to carefully look at the settlements and see if there's any deemed settlements that we weren't perhaps expecting. I know that there will be because I've come across it already in the trust returns that we've started doing. So ultimately, we're going to take time. It's going to be very careful as we apply the new law individually to every single client. And we have to check everything carefully before we file it around August. In the OS 22-02 operating statement, feel free to write that down. There are 10 examples. I guarantee you, your example of your trust won't be there. So 10, every trust that I have in the practice is slightly different from others. So this statement's only 48 pages, just 10 examples. It won't be covering everything. However, as I said to you, because of the frequently asked questions and the information that Inland Revenue will be collecting and then distributing to the accountants, we're all going to be learning in this space quite hard in the May, June, July period. And so by the end of beginning of August, I'm pretty sure we will have done enough returns to make sure it's correct. Now, if you're an accountant on this webinar is not actually designed for you. I'm running an online workshop for accountants in June, and I'm very happy to go through some worked examples and bring any examples that you are struggling with to that workshop, and we can go through it together. I invite you to register it by sending me an email. But if you're a client, then these are the sort of the costs that you can expect for your trust tax return this year. And we will go through this with you individually and work out what is going to be the correct cost for you. It will be additional work to what is on our monthly proposal, because this this requirements, they weren't there last year when I set the prices. So we are going to have to charge additionally. So what do you do next? So I'm suggesting that if you're a trustee of the firm, please feel free to phone the office and arrange a trust review with us, and do this before you decide to make your trust inactive, just in case it actually can't happen that quickly. Secondly, gather all the information requested in the slide previously, and you know, make sure that you know the reasons why you want to keep your trust structures. We will plan to contact you. We will be doing that throughout the year. We usually schedule our work through the year, and so we'll be contacting trustees a month before we usually prepare their tax return. And if you don't already, please consider using a professional administration service to make it easier to comply with AML, Trust Act, and now the Taxation Amendment Act. So there's all these different rules. So in summary, there's now an updated IR6 tax return that we have to comply with. There's an IR6B and an IR6S. They are new. And there might be many IR6Bs if you've got more than one beneficiary in your trust. So that's increased reporting requirements. Active trusts or inactive trusts, or trusts with very small amounts of investments in them, should become inactive trusts as far as income goes as soon as possible, almost always. Active trusts, it's a good idea to review them, review your reasons, make sure that you're being as effective with your trust as possible, and there will be some extra costs to having trust this year. And filing the tax return is a lot more complicated, but hopefully not as scary as before. So this is a time to ask any questions. Feel free to ask any questions right now. Thank you. So every client situation is different. Every trust is going to be different. It's a new area. There will be questions that you have in your own mind. So, okay, I've got all these new rules. How do they apply to me? We actually have to go through your balance sheet and work that out individually. So, any questions there, Rhonda, that have come in?
None have come through so far. We did have one that was answered as you went through some of the slides, so that was good. That was a question about examples of beneficiaries giving over 25,000 to a trust.
And another example of that is if you've distributed income of over 25,000 to a beneficiary, but they haven't taken it out, so it's sitting there in the balance sheet. Now I've been doing that for years and years. So that's going to become a very frequent settlement, or we obviously have to pay it out. So yeah, earlier. So as I say, I gave you some next steps. So I hope this webinar has been helpful to you, and please get in touch. I look forward to meeting you all individually as we go through these new rules together, and hopefully we'll get to phase 5 and have success and fulfillment in completing these new rules. Thanks for joining me, everybody, this afternoon. Have a great day.